Hello and welcome to the November edition of Market Compass. Today, we'll focus on performance and the outlook for fixed income. Specifically, we'll talk about, first, how the rise in yields differs in 2023 versus the rise we saw last year. Second, we're going to talk about some reasons why the November rebound might be the start of a sustainable recovery in bonds. And finally, how to position fixed income portfolios to take advantage of the potential inflection point that we see ahead. Let's start with performance. After a disappointing year for investors last year, balanced portfolios are on track to end this year on a positive note. But US megacap tech stocks have largely driven the gains, while bonds remain under pressure, though they have started to recover recently. Up until the end of October, US investment-grade bonds were on track for their longest stretch of losses. Since the start of the US Aggregate Bond Index in 1976, there has never been two or more back-to-back negative years. Last year, long-term rates surged as inflation spiked to a four-decade high, and the Federal Reserve responded with aggressive rate hikes. This year, however, inflation is declining and the Fed is most likely done with rate hikes. So, why the lackluster performance? We would attribute the move higher in rates for most of the year to, first, the stronger-than-expected economy, which implies the Fed might keep rates elevated for longer. Second, higher Treasury issuance to fund the fiscal deficit. And third, technical factors such as negative investor sentiment. In our view, we've seen the perfect storm for bonds. But conditions now seem ripe for a rebound. In November, the 10-year Treasury yield fell from a 16-year high of 5% to around 4.5%, providing much-needed relief. The November gains could be the first step in a sustainable recovery that could materialize in 2024 and beyond. Here are 4 reasons to be optimistic despite the disappointing performance of bonds over the past 3 years. First, inflation remains on a downward path. The last 2 readings of the Fed's preferred measure of inflation have fallen below 4% for the first time in 2 years. At 3.7%, core inflation is still a long way from the Fed's 2% target, but we think the downside pressures will persist. Wage growth is decelerating, housing inflation is cooling, and oil prices are back into their recent range of around $75, which is 20% below their late September high. Second, growth will downshift in the quarters ahead. The economy proved to be surprisingly resilient in 2023, supported by a strong consumer and a tight labor market. We don't expect growth to fall off a cliff, but we think pressure is building on the consumer as the labor market is gradually cooling and lending standards are tight. The silver lining is that the expected slowdown, modest slowdown, will also keep inflation in check. This brings me to the third and very important reason why we believe bonds are likely to perform better next year. The Fed might not hike further given the slowdown in inflation and a cooling labor market. We think the Fed will likely stay on pause as it evaluates the impact of prior rate hikes before cutting rates likely in the second half of 2024. This graph shows that over the past 40 years, bond returns were muted and, in some cases, negative before the Fed hiked rates for the last time in a cycle. But yields have always fallen after the Fed's last hike, with bonds achieving above-average returns 6 months later. This highlights that the end of tightening can be a positive catalyst for bonds, with yields potentially having already reached the peak level for this cycle. And finally, valuations are attractive. Historically, one of the best predictors of forward bond returns is current yields. Here you can see that returns for investment-grade bonds over a 5-year period have tended to match their starting yield. For example, yields were around 5.6% in 2007, a similar level to today, and bonds returned a little over 6% on average per year in the 5-year period between 2007 and 2012. We believe the high starting yield in 2023 could produce high returns, setting the stage for a bond market comeback in 2024. At a minimum, the larger income component can better offset price declines, making a repeat of last year's losses less likely. With bonds potentially representing a more compelling opportunity than they have in years, how should investors position fixed income portfolios? It might be tempting to gravitate towards CDs and cash-like investments, which yield more than 5% with little or no price risk. However, bonds with longer maturities and higher interest rate sensitivity can offer the opportunity to lock in the historically high yields for a longer period. They may also appreciate in price if growth softens and the Fed starts cutting rates possibly in the second half of 2024. We recommend investors build a bond ladder with an appropriate exposure to intermediate and long-term bonds, which can complement their cash positions. We think the bond allocation of the US aggregate index provides a good starting point for diversification. If CDs represent an oversized part of your fixed income portfolio, consider reducing your allocation to cash or reinvesting the maturing principal into longer duration bonds. To sum up, while this is hard to pinpoint, we think yields might have already reached a cyclical peak as economic growth slows, the Fed pivots to rate cuts in 2024, and inflation gets closer to the Fed's 2% target. Volatility in bonds will probably stay elevated for a while longer, but we expect a rebound in prices, especially for those bonds with longer maturities that have been hit the worst. With that, thank you for joining us. We hope to see you again next month for another Market Compass.